I'm Namrata Hadley, Business Manager at Auckland Business Banking. Welcome to our third Expert Talks webinar on the effects of the elections and financial markets with Mike Shirley, Senior Trader at Kiwibank. Mike is part of our financial markets team, managing risks and exposures in foreign currency and interest rates. The financial markets don't move independently of each other, so part of his job is to keep a close eye on equities, commodities, international and domestic headlines and economic events. You can catch him most mornings on YouTube on his popular series Markets in a Minute, discussing all these things and more. Mike's banking career going back to the pre-GFC era has comprised risk, sales and trading roles. Today, Mike will talk through what election fever, both domestic and international, might mean for the financial markets and the New Zealand dollar in particular. Mike will also discuss why markets react to such events and how you, as business owners or advisors to business owners, might be able to mitigate your exposure in what could be a very volatile and uncertain period going forward. We hope you get some valuable insights from this webinar today. Thank you again for being here, and I will hand over to you, Mike.
Good morning. Thank you, Namrata. Yeah, it's a very nice introduction. Yeah, I am Mike Shirley. Welcome, or welcome back, I guess, if anyone saw me earlier this morning on Markets in a Minute. Little plug for our YouTube channel. Give that a Googs, I guess, if you're interested, or just click on that link that's on the screen now, kiwibank.co.nz/business. It's all in there. Okay, I guess we'll crack in. Lots to cover, so on with the show. Here we go. So this morning we have a presentation in 3 parts. This is essentially my checklist here to keep me on track. So we're going to kick off with some brief historical analysis on the New Zealand dollar, the Kiwis' reaction to a major risk event, elections. Yeah, pretty topical at the moment, really. We'll touch on what you can do to insulate yourself or your business from potential currency volatility around risk events like elections, and then take a look at the potential implications of a looming New Zealand dollar risk event, the US presidential election. It's what is it, a little under 2 weeks away now. Okay, we're 2 slides down. So let's start with part 1, election fever, by having a look at the New Zealand dollar's reaction to the election just gone, last weekend's election. And yeah, here we go. In short, yeah, it didn't really react at all. I snapped this headline catcher thing from Bloomberg when the markets opened on Monday morning, 7:05 a.m. and 19 seconds, apparently. But yeah, New Zealand dollar quoted 0.2% higher at open after Ardern win. I mean, that sounds sensationalist. Oh, and the red text, it's just a coincidence that's not implying or suggesting anything. But yeah, applying a bit of context, 0.2% New Zealand dollar terms, that equates to a move of about 13 points. So the exchange rate moving from 66.6600 to 0.6613. And that is, it's not a lot. On any given uneventful day, you know, when there's not really anything going on, the New Zealand dollar might trade a range of 20 or 30 points. So 13 points on a seemingly important risk event like an election, it's a bit of a yawn fest, really. So for a bit of a compare and contrast then, let's roll the clock back to the 2017 New Zealand election. Very different outcome, no clear winner on the day, but the National Party did secure the popular vote. That's this little blue box right here. And yeah, the New Zealand dollar inched a bit higher on that outcome, about 100 points or around about a cent. Now, of course, as we all know, a few weeks later, we had confirmation of a Labour-led coalition government. That's this red box right here. And yeah, the Kiwi fell by almost 1.5% in the hour or so immediately following that announcement. And then it fell by a further 1.5%-ish over the next day or so. Yeah, and the Kiwi then kept falling. If you can see my little red dot on the screen there, and the green line going down. In late 2017, the New Zealand election, yeah, it wasn't the only show in town. US-China trade war, it was dominating headlines and the markets. So yeah, look, with a bit of charting and modelling, jiggery pokery, we can approximate how much of that late October New Zealand dollar move is actually election outcome attributable. If we look at the relative performance of the New Zealand dollar to the US dollar, and the Aussie dollar to the US dollar, so the Kiwi and the Aussie, over that election period. And if we assume that negative or positive US-China headlines will have a similar impact on both the Kiwi and the Aussie, which is not an entirely unreasonable assumption, it's pretty fair, then you arrive at this chart here. That's the Kiwi in light green, the Aussie in dark green. And yeah, if we plug a little arrow in there, we can broadly attribute the election impact out. Sorry, we can broadly attribute the outcome of the election to that gap between the two, that little red line there. Yeah, which is around about 2.5% to 3%. Yeah, pretty snazzy. Okay, let's keep cracking on. So, thinking about those two charts, then, why was last weekend's election result a fizzer, volatility-wise, at least for the New Zealand dollar, when 2017 was, yeah, a lot more volatile? So we're going to put our trading hat on and, yeah, look at some broad market concepts. And, yeah, there are three key ones that we are going to focus on today: forecasts versus actuals, or, you know, expectation versus reality, really. Trading themes. This is pretty broad. Yeah, it's very broad. But okay, so fun fact, the New Zealand dollar, it is the 10th-ish most actively traded currency globally, which is kind of at odds with our ranking of 50th-ish, sometimes 49, sometimes 51st, in terms of GDP. Yeah, that's probably a presentation in and of itself. But yeah, look, our attractiveness to currency traders, it's a blessing and a curse. So the blessing, it provides liquidity, and when you are a free-floating currency, such as the New Zealand dollar is, liquidity is essential. Plenty of people prepared to buy and sell at a given price. Yeah, but that comes with the curse of increased volatility, exacerbated moves. Yeah. Anyway, for this morning, we are going to focus on the use of the New Zealand dollar as a proxy for risk sentiment. And the third point on my little slide, perception. We will look at, we're going to look at the specific example of business confidence in the context of the local election. Yeah, in a few slides' time. First, though, forecasts versus actuals. You know what I've noticed? Nobody panics when things go according to plan. It's a quote from Heath Ledger's Joker from the Christopher Nolan film The Dark Knight. Big fan of Batman and Star Wars. Anyway, yeah, look, Heath Ledger, he summed it up nicely. How markets react to data and events, good and bad. It's of less importance than forecasts and actuals. Yeah, this one alone pretty much explains the 2020 New Zealand election outcome for the Kiwi. It went more or less according to plan. Yeah, so there was a muted currency reaction. In 2017, the plan was a little bit loose to begin with. We didn't really have a firm view of the outcome. And yeah, the ultimate outcome was a fair way off consensus expectations anyway. So a panicked reaction. Yeah. Okay. What was next? Proxies. Right. So two major categories here: perceived safe havens and risk-related assets. So the top row, with my little red dot, there we go. These are a couple of the usual safe havens. So we have gold, we have the US dollar, we have the Japanese yen, and we have bonds, government bonds, sovereign debt. Yeah. On the other side of the equation, we have risk-related assets like the globe's 10th most frequently traded currency, the New Zealand dollar. We have commodities like oil in this little picture here, and equity markets, of course. Okay, so each of these financial assets, they can and do move independently based upon relevant data and events. Just get my little dot out of the way so it's not distracting. Yeah, but from a broader thematic perspective, they're used as proxies to increase or reduce exposure to risk, wider risk. So stock markets, yeah, look, they are probably the clearest and cleanest example of a risk asset. I know we're mainly looking at elections, but if we quickly switch focus to the start of the global COVID lockdowns back in March of this year. So equity markets, they tanked, and there was a broad selling of risk-related assets. And yeah, the money from that selling was then invested into safe havens. Yeah, not long afterwards, risk sentiment, it swung the other way, sort of a double switcheroo, and safe havens were dumped in favour of risk assets again. Yeah, so that's some general background, I guess, but the moral of the story here is the New Zealand dollar, it's frequently employed by global financial markets as a way to adjust your exposure to risk in a hurry. Yeah, okay, and finally, third slide, perception. Right, so for example purposes, here's a common perception: a Labour government is bad for the business community. Yeah, is that statement true? Maybe, maybe not. It's certainly not a statement of fact, it's a statement of opinion. Financial markets don't care about your opinion unless those opinions come in the form of data or influence data, like the ANZ Monthly Business Confidence Survey. Yeah, and we can see here, business confidence ebbed as the 2017 election loomed and then tanked when the results were revealed. That's the That's that red block area there. Now, looking a little further beyond this election period, yeah, confidence remained depressed, remained subdued. And again, look, New Zealand election wasn't the only show in town. That wasn't the only driver. The US-China trade skirmish, I guess. Yeah, that was hardly a boon for business confidence. And then by the end of 2019, we can see here confidence was starting to improve. Little green circle there highlighting that area. Yeah, but then of course 2020 came along and well, that's an entirely different kettle of fish. And again, another presentation on its own. But look, basically what we've done so far is we've used local elections to highlight some markety stuff, basically some of the hows and whys of currency reaction to event risk. Yeah, definitely not an exhaustive list, but it's a base. Yeah, so let's take a look at the impact of the 2016 US presidential election on the New Zealand dollar. Fun chart here. Okay, so this chart is daily movements in the Kiwi during the final months of 2016, and the reaction to the US election. Yeah, it's pretty much that that big chunk in the middle, that piece right there. That is a peak to trough move of around about 6%. Now, on the face of it, it seems a bit odd. If you think back, 2017 election had a 3% move in aggregate peak to trough. Yeah, it seems a bit odd that a surprise outcome in a domestic election would have less impact than a foreign election. So it's worth pointing out at this point, I guess, that not all foreign elections had the sort of impact that we see in this chart here. Scott Morrison, Prime Minister of Australia, his somewhat surprising re-election across the Tasman in 2019. Yeah, that didn't prompt a response of this magnitude at all. Mr. Morrison's, semi-upset win, that's a remove in the Kiwi-Aussie of next to nothing. And they're our next door neighbour and our second largest trading partner. Yeah, another fun fact, the Australia's largest export is boomerangs. Yeah, it's also their largest import. Yeah, I'm a dad. It's a dad joke, so it's totally fine for me to say that. Yeah, an actual fun fact or funner fact, the US, they are our fourth largest trading partner. Yeah. Interesting. Anyway, back to the chart. Let's look at the Kiwis' reaction to the 2016 US election in terms of our three trading themes, forecasts, proxies, and perceptions. So, heading into the election, Hillary Clinton, she was the odds-on favourite, tracking at around 70%. And yeah, things didn't go to plan and the market panicked. And that panic was expressed via proxies. Sell the proxy for risk, the New Zealand dollar, buy the proxy for safety, the US dollar. And when you sell the New Zealand dollar, its value decreases, it goes down. And perceptions. Donald Trump, he was running as a Republican, traditionally perceived as business friendly, whether they are or not, irrelevant. But he wasn't a traditional candidate. So yeah, created some uncertainty there as well. Now, condensing all of those three areas into a succinct phrase that my soccer coach drummed into me when I was a young, impressionable young man. Said young twice, sorry about that. If in doubt, kick it out. Yeah, and that's how this all played out in the real world. Basically, you're let's run through an example. You're a stock market trader, right? In the US, it's 2016, the results are coming in from the election, equity markets are closed, and yeah, you can trade futures and after hours, but it's much easier and much quicker to just sell something that in times of panic has a reasonable correlation to equity markets. Yeah, something that has oodles of liquidity and something that is trading in a market that is open. And the little old New Zealand dollar, it ticked all of those boxes. Yeah. So in summary, New Zealand election shock, kind of a big deal for the Kiwi. US election shock, much, much bigger deal for the Kiwi. Now, after the 2016 election, the New Zealand dollar did later recover. You can see the little green line trending higher here. For the purposes of this morning's presentation, we are just looking at event risk, so the red block, the short-term movements in currency markets in and around elections. But look, the rationale, the tools, everything that we're discussing this morning could be applied to any event risk and probably any market. Just swipe out a couple of variables and, bing, bang, boom, you're there. Okay, so look, all these charts and stuff, it's all very nice, but what does it mean to me? Let's get some relativity in play. So 2017, New Zealand election, Winston Crowns, Jacinda Ardern, Prime Minister. Yeah, you or your business, you're importers of widgets. Yeah, and you pay your supplier in US dollars and your customer pays you in New Zealand dollars because they live in New Zealand. Yeah, pretty standard importing stuff. You price your sale at the prevailing spot rate heading into the event risk and yeah, boom, Winston's decision. just eroded 3% of your margin. Or put another way, if a container load of widgets had a price tag of 700,000 US dollars, your cost in New Zealand dollar terms, they've gone up by about 30 grand, a little bit more. Yeah. 2016, Hillary failing to get across the line, a near 6% decline. That one hurts your widget business bottom line a little more, a lot more, about 60 grand, a touch over 60 grand more. Yeah. So look, there is risk here. But what can you do about it? Yeah, in a word, or in a picture, there we go, picture, hedging. Hedging, if you're not familiar with that terminology, basically think hedge your bets. Yeah, there is an event risk coming up, a US election in this instance, and yeah, your little widget business, or whatever your business is, has a currency exposure. You're going to be financially impacted by a movement in the exchange rate. Now, that movement could be beneficial or it could be detrimental. Maybe you want to remove the impact of that volatility, that risk, because you don't want to have sleepless nights worrying about it, or whatever it might be. That's where banks come in. That's where Kiwibank Financial Markets comes in. We can take that risk off your hands, basically make your problem our problem. But that's cool, because your job is the importing and selling of widgets at a viable and sustainable margin, and our job is managing financial risk. It's what we're good at. It's a good match. Yeah. So that's what hedging is, essentially. Yeah. I guess the next question then is, do you even need to hedge? Yeah, this is where it gets tricky in a webinar, because I don't know the specifics of your real or imaginary widget business, and I'm not here to give advice. Yeah, those these questions on the screen are things you'd probably want to ask yourself. You know, do you need to hedge? Maybe not if, maybe yes if. Do you want certainty? Yeah, hedging, look, it might not always be appropriate, but if it is, it's important to remember, look, there's no free lunch. If you need certainty, that's cool, but there may be an opportunity cost as a result of gaining that certainty. Let's just quickly go through some of the lingo and some of the basic hedging structures. Anyway, quick overview of hedging. This will be a bit of a refresher for some, and maybe a bit of edutainment for others, and maybe a bit of sizzle for a future webinar. Another one, Hamish Wilkinson, he can do that one. Yeah, a colleague in the dealing room. Anyway, quick examples of how these three work. So, spot contract. You give me 100 New Zealand dollars today, and I will give you about 66 US dollars today. Easy. Forward exchange contract. You agree to give me 100 New Zealand dollars in 3 months' time, and at that point, I will give you 65 US dollars. We're both obligated, and whatever the spot rate on the day is, doesn't matter. FX options. Okay, you agree to give me 100 New Zealand dollars in 3 months' time, and at that point, I will give you at least 65 US dollars, but I might give you more depending on what the spot rate is on the day. If it's more favorable to you, you can transact at the more favorable rate. But to get that benefit, that optionality, you have to pay me a premium upfront. You have to pay me cash. Yeah. So, okay, that is a super quick, bare bones summary. There is clearly a lot, like so much more to hedging than just what we see on the slide here. But the slide is really just to highlight that there are means and ways to hedge your FX volatility and event risk. Okay, let's get into the third act. So we've looked at why financial markets react to risk events, elections specifically, and surprise outcomes. Yeah, and we have looked at the bare bones basics of FX risk mitigation, hedging. So the third act of this morning's show, we're going to apply that either newfound or refreshed, knowledge, thinking to the next big risk event, the 2020 US presidential election. Right, we want to try and formulate a forecast. So I've taken this the screenshot from predictit.org, which is basically a publicly available futures market. Really, if you believe people are going to vote with their heads or their wallet rather than their heart, put your money where your mouth is sort of thing, then yeah, this is probably a reasonable forecast tool. Without getting bogged down in the maths or mechanics of how futures markets works, the numbers here pretty clearly suggest that Joe Biden is the favorite, but a Trump win, certainly not out of the question. So is this a perfect forecast? No, absolutely not. There is no such thing as a perfect forecast, but we need something to compare the actual outcome to. We need a metric to measure, a metric of surprise is what we need. Yeah, and if you think back to the Batman slide from earlier, good and bad of less importance or doesn't even matter. It's forecast versus actuals that we're really focused on. Proxies. Okay, so basically we want a barometer. there's a barometer, just like I used to see at my grandma's house when I was little. We want a barometer to gauge market sentiment to the evolving situation. And it's going to be a Tuesday night in the US as the election results come in, but Wednesday afternoon in New Zealand. So equity markets, yeah, the go-to barometer of risk. They are, they're going to be closed. And sure, you can trade after hours, futures, everything else, but it's not as clean or as clear. So, if there's something better, we might want to jump on that wagon. Now, in 2016, the market used the US dollar to the peso as a proxy trade for election risk. There was a lot of focus on a wall and trade deals at that point in time. Dollar peso, it made sense in 2016 for trading the election, but it's not really as relevant this time. So we could consider maybe dollar yuan. US-China relations have certainly been a focus of markets in recent years, but yeah, that focus has shifted in 2020 clearly to something more global. So look, not really a suitable risk event proxy there either. So what do we do in situations like this? I guess US risk event proxies in general, they're like nicknames. You can't force it. It's just going to happen. And I'm not sure there is a good one this time around. If you have any ideas, I would love to have them. Find me on that the website link on the front. If we go back to the tried and true, you're probably looking at stock markets and the New Zealand dollar. Yeah, look, it's reasonably correlated to equity movements. So back to the old faithfuls. That's proxies. Let's move on to our third trading mentality thing. We want to get a handle on how the market might perceive one outcome over the other. Again, can't emphasize this enough, the market doesn't care about personalities, even if we do. All it cares about really is consensus perceptions. So look, I've made a list here of some broad market drivers, sentiment drivers, and we're going to do some emoji analysis. Yeah, I was going to have little arrows pointing up and down, but maybe that infers something that I don't want it to infer, and there's something innocuous about a little yellow smiley face. So, we just want to try and understand how the market might perceive a specific outcome in order to gauge the potential reaction. So, if we start with Mr. Trump here, the incumbent, he is a non-quantity. So, like him or not, if he gets back in, the market knows what it's getting. So, from a risk sentiment perspective, that's a smiley face. Larger price adjustment. Look, he's not the favourite going in. So, if there is a win, then that's kind of a booster to the known risk smiley face. Yeah, 2-for-1 kind of styles. Fiscal stimulus. If you follow Markets in a Minute or our written commentaries or anything else at the moment, or even read the news, I guess you'll be well aware that fiscal stimulus, it's a massive driver of risk sentiment globally. Now, Republicans, they're seemingly less keen on a big splurge, and we do know that risk assets respond favourably to a big splurging stimulus package. So we've given this a frowny face from a risk sentiment perspective. China policy. Okay, so should COVID come under control, the US-China trade dispute, that may well return to prominence for the market. So that is probably a frowny face. And then we have transition risk. Semi-political here. President Trump, he's made some noises about maybe not accepting the outcome of the election if it doesn't go his way. That creates uncertainty. And coming back to the sage advice of Coach Wheeler, if in doubt, kick it out. So you dump risk assets and buy safe havens should Trump lose. But if he wins, then the transition isn't a problem. So smiley face. Yeah, there we go. Interestingly, this one here, smiley face, should he win, that's what we in the market call a potential relief rally. Yeah, sigh of relief, things go up. Okay, Biden, comparatively unknown quantity. So comparatively, that's figure quotation marks if you can't see. We do know who he is. He's been in office before, but relative to the incumbent, comparatively unknown. So mild negative, it's a little frowny face, I guess. Smaller price adjustment. Look, he is the favourite. So there is more priced in to his winning, I guess. So that's also a smiley face, but more just to offset some of the frowny face from the comparatively unknown quantity above. Yeah. China policy. Okay, so fiscal stimulus. Sorry, I missed one, didn't I? Democrats, they're apparently keen on, opening that coin purse a little bit wider. We talked about fiscal stimulus before, so that's a smiley face. Yeah, more fiscal stimulus, better for risk assets. China policy. Okay, so this one, it's a little bit trickier. It's maybe neutral. I found this one, this little emoji, but yeah, it's getting too far, a little bit too far in the realm of policy. So kind of trying to avoid or dance around this. Will he unwind Trump's previous actions immediately? Who knows? So this emoji seems appropriate. Third and final one, transition risks. So yeah, I mean, look, we talked a lot about this, or I talked a lot about this rather, you're just listening, in the Trump incumbent section. It's probably a frowny face because it's probably going to be a negative for risk if the winning margin is tight. So the magnitude of the negativity, yeah, probably inversely correlated with the winning margin. So the bigger the winning margin for Joe Biden, the less uncertainty, so the less risk. But there is still going to be a risk. Yeah. So yeah, there we are, some generalized assumptions. Look, you could argue most of these the other way. In fact, that is how the markets work. Yeah, if everyone had the same view, you wouldn't have an efficient market. And if we had time, we could get nerdy here and talk about the three forms of the efficient market hypothesis. But we don't have lots of time. So instead, let's take our analysis, a very loose sense, and apply it to the New Zealand dollar. Here we go, bring it all back to Kiwi. Okay, so our emoji analysis, that suggests that whatever the outcome, we're probably going to see some New Zealand dollar volatility. Yeah, forecasting expected outcomes, right? Look, you can do that till the cows come home, but and it can be useful, but you can also tie yourself in knots. So volatility is probably the key takeaway. The next one, yeah, look, the market doesn't care. The market doesn't care. The New Zealand dollar, fair or not, it's a proxy for risk, and this is a big risk event. There is going to be volatility as those results, the results of the outcome trickle in, regardless of what the outcome might be. And look, if you've got exposure and you're worried about it, yeah, get something done about it early, perhaps, or consider doing something about it early. Not advice, absolutely not financial advice. The other thing you'll want, in addition to all of this, is probably some quality research and information, because, and this may come as a shock to you, or to some, maybe not to many, some things on the internet aren't true. There we go. Fortunately, we have got you covered. Yeah, so everything that we've discussed this morning regarding the market's take on the November US election, it's based upon how things currently stand. Yeah, we are just one soundbite, one headline, one tweet away from all of that changing. And look, markets, they're not really in the business of measuring twice and cutting once. They are shoot first, ask questions later. Shoot first, just like Han Solo. There we go, Star Wars reference. Batman and Star Wars in the one presentation. Outstanding. Yeah, anyway, not everyone gets to sit in front of big data screens all day long looking at news and headlines. But look, the financial markets team and the Kiwi economics team, we do. Yeah, and we produce a steady stream of content, market commentaries, research, analysis, YouTube videos for our customers, our clients, our friends at the bank. You can see some of the fun stuff here. Yeah. So that's all available to you should you wish to receive it. Yeah. What else can you do? Well, you can engage with trusted advisors like this good-looking bunch of people right here. Just someone who understands your specific circumstances, and if appropriate, yeah, they can advise you on how you might best manage your risks. I guess, look, if all you take away from this morning's presentation is, hey, maybe I should identify what my risks are and have a conversation with someone about it, then that's probably a pretty good outcome, I think. Yeah. So look, if you're not already engaging with us, the Kiwibank Financial Markets team, your first port of call should be to contact your business banking manager, or if you're not with us, kiwibank.co.nz/business. Yeah, that's a good place to start. Yeah, even if you're not worried about the US election in a little under 2 weeks, or you don't have any near-term currency risk to manage, look, there's always another risk event. There's always another source of New Zealand dollar volatility, like RBNZ announcements, like COVID, like US-China tensions, like Australia-China tensions. That's one is actually starting to pop up a fair bit. And then let's not forget this happy fellow with that wonderful haircut. Yeah, arguably the next cab off the major offshore risk ranks, Brexit. Yeah, another one just around the corner. And with that, yeah, we're up to the second to last slide, the fine print. Yeah, just to clarify here, I think it'd be drawing a pretty long bow to call anything I've talked about financial advice. Yeah, this slide just reemphasizes that. Yeah, compliance, it's a subject dear to my heart, dear to my heart. Anyway, yeah, I'm Mike, and this is my picture. Yeah, Nimrata, back to you, I guess. I've spoken more than enough. Thanks.
Thanks, Mike. That was awesome. That's all we've got time for this morning. Thank you very, very much, Mike and the team, and thank you to everyone that's joined us today. I hope you got some good insights out of the talk. If you've got any questions or you'd like to discuss what was spoken about today, please contact your relationship manager at Kiwibank, or you can find us on kiwibank.co.nz/business. Thank you everyone again, and have a wonderful day. Bye.